In the world of finance, there are moments of quiet and there are moments of seismic change. We are living through one of the latters. Gold and silver, the ancient sentinels of economic uncertainty, are flashing signals that have captured the attention of everyone from seasoned Wall Street traders to everyday citizens worried about the value of their savings. The price of silver has surged, climbing nearly $1 in a single session, while gold stands defiantly near its all-time peak, creating a tense and opportunistic atmosphere for investors worldwide. This isn't random market noise. This is a direct and powerful reaction to a pivotal, and perhaps contentious, decision made within the hallowed halls of the United States Federal Reserve. The Fed, in a move that was widely anticipated yet still sent shockwaves through the system, has just lowered interest rates, unleashing a torrent of chaos and opportunity across global financial markets. This single action has become the focal point of intense debate and speculation, forcing a reevaluation of economic forecasts and investment strategies for the foreseeable future. But the story doesn't end with the Federal Reserve's announcement. In a stunning and significant turn of events, the mainstream financial media, often dismissive of hard assets, is now actively advocating for holding gold. This represents a monumental shift in sentiment that cannot be overstated. The endorsement from traditional financial news outlets provides a new layer of validation for precious metals, suggesting that concerns about economic stability are becoming more widespread and are no longer confined to a niche group of investors who have long championed these assets. This confluence of events forces us to ask the most critical questions facing investors today. What is truly happening behind the curtain of our global economy? Why did the market react with such whiplash volatility to the Fed's highly anticipated announcement? And most importantly, where are gold and silver, these timeless stores of value, headed from here? Today, we're going to unpack it all. We will dissect the Fed's decision, explore the brewing storm of inflation, and build the case for why one of these metals in particular might just be the sleeping giant of our time. Let's begin with the catalyst for this recent market frenzy: the Federal Open Market Committee's decision to lower its policy interest rate by 1/4 percentage point. For weeks, the market had been abuzz with speculation, and traders and hedge funds had been placing their bets, anticipating this exact move. This is the classic financial scenario known as buy the rumor, sell the news. The anticipation of a rate cut, which is generally bullish for non-yielding assets like gold and silver, had been steadily pushing their prices higher in the days leading up to the official statement. Then, the moment the official statement was released confirming the quarter-point cut, a wave of volatility was unleashed. In a textbook sell the news reaction, those who had bet on the announcement took their profits off the table. The price of silver took a sharp, immediate dip, falling to a low of $41.66 an ounce on Wednesday. For a moment, it seemed as though the rally had been a mirage. A speculative bubble popped by the very news it was anticipating, leaving many to wonder if the upward momentum was over as quickly as it had begun. But then something remarkable happened. The dip was not a collapse, it was a springboard for a new wave of buying. The market absorbed the profit-taking, found its footing, and then roared back with a vengeance. As we stand today, silver isn't just back to where it was before the Fed's announcement. It has surged past those levels. It now sits confidently at $42.90 an ounce, knocking on the door of the psychologically important $43 mark. This represents a powerful daily gain of over 2.25%, a significant move in the commodities market. This recovery and subsequent push into new territory speaks volumes about the underlying strength and conviction in the market. It suggests that this is not a speculative flash in the pan, but the beginning of a more significant foundational shift in investor sentiment. The market's ability to absorb the sell-off and climb higher indicates that the reasons for holding precious metals are more profound than simply betting on a single central bank decision. It points to deeper-seated concerns about the economy that are now driving capital into hard assets as a long-term strategy for wealth preservation. Gold experienced a similar dance of volatility, although its story has a slightly different nuance. The king of precious metals had set a spectacular new all-time high just last Tuesday, cresting at an astonishing $3,689 an ounce. Like silver, it saw a pullback following the Fed's confirmation of the rate cut. While it has also shown significant strength and is climbing once more, it has not yet fully reclaimed that record peak, currently trading about $8 below that high-water mark. This shows the resilience of gold, but also highlights the relative momentum seen in silver. This divergence, with silver showing more aggressive upward momentum post-dip, is a critical thread we will pull on later, as it forms the basis of a powerful investment thesis. The takeaway from this immediate market action is clear. After a week-long roller coaster ride, the initial volatility has settled into a powerful upward trend. This suggests that the Fed's move was not the end of the story, but merely the firing of the starting gun for the next major leg up in the precious metals market, signaling a new phase of investor interest and price discovery. To truly understand where we're going, we must first look deeper into the institution that holds so much sway over our financial lives, the Federal Reserve itself. The decision to cut rates by 25 basis points was not a unanimous one, and within that dissent lies a fascinating story about the immense pressures shaping our economic policy. One newly appointed member of the committee, Stephen M. Mnuchin, cast a dissenting vote. He wasn't against cutting rates. On the contrary, he was advocating for a much more aggressive move, a 50 basis point or half a percentage point rate cut. This isn't just procedural trivia. M. Mnuchin's position is significant because of his well-known political affiliations. His desire for a more aggressive, stimulative monetary policy aligns perfectly with the oft-stated goals of political figures who prioritize short-term economic growth. This dynamic inevitably raises the thorny and critical issue of the Federal Reserve's independence. The perception of an independent central bank is paramount to market stability, and any suggestion of political influence can have far-reaching consequences for the credibility of its policies and the currency it manages. During the post-decision press conference, the Fed chair was directly confronted with this very question. How can the public trust that the Fed is acting as an independent, nonpartisan entity when there are clear political pressures at play? The chair's response was, as expected, a masterclass in diplomatic deflection. He welcomed the new committee member and asserted that the committee remains united in its pursuit of its dual mandate of price stability and maximum employment. This carefully worded statement was designed to reassure markets without directly engaging in the political debate. He concluded by stating, "We're strongly committed to maintaining our independence," before making it clear he had nothing more to add on the subject. This reaffirmation of independence is crucial, because the perception of it is the bedrock upon which the dollar's credibility and the market stability are built. If the public and global markets begin to believe that monetary policy is being dictated by short-term political whims rather than long-term economic data, faith in the currency can erode with alarming speed, leading to potentially chaotic outcomes for the entire financial system. Yet despite these official assurances, the market is already looking ahead, and it sees a clear path of continued monetary easing. The probabilities baked into the futures market are signaling a clear expectation of at least 2 more rate cuts before the year is out, one likely in October and another to close out the year in December. This forward-looking sentiment is incredibly bullish for assets like gold and silver. It tells investors that the era of easy money is not a temporary blip, but a sustained policy direction from the central bank. This environment, characterized by lower borrowing costs and an increasing money supply, is the very fertilizer in which precious metals prices have historically thrived. The expectation of continued rate cuts undermines the value of holding cash and bonds, pushing investors to seek alternative stores of value that can protect their wealth from the erosive effects of an expansionary monetary policy. For many, gold and silver are the most logical and historically proven safe havens in such a scenario, setting the stage for increased demand and potentially higher prices in the months ahead. This policy direction brings us to the elephant in every economic discussion today: inflation. In the wake of the Fed's decision, veteran market commentator Peter Schiff offered a scathing critique that cuts to the heart of the matter. He pointed out that when the Fed projects inflation returning to its 2% target within 2 years, it isn't truly a forecast based on concrete data. He argued that it is more of an aspirational goal, a hope rather than a high-conviction prediction based on a sound analytical framework of the current economic conditions. As Skiff put it, this is not really a forecast but a goal. In reality, it's wishful thinking disguised as a legitimate forecast. His argument is that the Federal Reserve has no real certainty about the future path of inflation and is simply hoping for the best while it continues to pursue stimulative policies. If inflation does not cooperate, if it remains stubbornly high or even accelerates while the Fed is holding rates low or cutting them further, it creates a deeply negative environment for savers and a powerfully positive one for hard assets. This is the concept of negative real interest rates, where the rate of inflation is higher than the interest you can earn on your cash, meaning your savings are actively losing purchasing power every single day. In such a scenario, non-yielding assets like gold and silver, which cannot be devalued by printing more of them, transform from alternative investments into essential tools for wealth preservation. The growing fear of this exact scenario is a primary driver behind the renewed interest in precious metals, as investors seek to shield themselves from the silent theft of inflation. What makes this moment so compelling is that this view is no longer confined to the traditional gold bug community. The argument has gone mainstream. A recent report from CNBC highlighted the views of Jeffrey Gundlach, the influential CEO of the investment firm DoubleLine. Gundlach has become so bullish on gold that he is now telling investors that an allocation of up to 25% of their portfolio to the yellow metal is not an excessive position, a statement that would have been considered radical just a few years ago. This is a radical departure from conventional financial advice, which typically suggests a small, single-digit percentage allocation to commodities, if any at all. Gundlach's reasoning is built on the twin pillars of persistent inflationary pressures and the prospect of a weaker U.S. dollar. He stated plainly, "I still think a 25% type weighting in gold is not excessive. I think that it is an insurance policy." His bold recommendation reflects a growing conviction among top financial minds that the current economic risks are substantial and require unconventional portfolio protection strategies to navigate successfully. He went on to say that gold is in a winning mode because of the dollar's weakness and that he believes this trend will continue. His use of the term insurance policy is precise and powerful. It frames gold not as a tool for speculation, but as a necessary protection against the systemic risks of currency debasement and runaway inflation. These are risks that a growing number of mainstream financial leaders now see as clear and present dangers, justifying a significant allocation to an asset that has preserved wealth for millennia. While gold rightfully captures headlines as it flirts with its all-time highs, the most compelling story of untapped potential may lie with its less glamorous sibling, silver. A thought-provoking article recently published on Seeking Alpha posed the audacious question, could $100 silver be next? The piece highlighted a crucial point that often gets lost in the day-to-day price fluctuations. On an inflation-adjusted basis, silver is nowhere near its all-time high, unlike gold, which is pushing into new territory in both nominal and real terms. This single idea opens up a fascinating and vital area of inquiry. What is silver's true, inflation-adjusted peak? The answer, it turns out, is not so simple because it depends entirely on how you choose to measure inflation. The official government metric, the Consumer Price Index or CPI, has undergone numerous methodological changes over the decades. According to research from sources like Shadow Stats, these changes have had the cumulative effect of systematically underreporting the true cost of living, which has profound implications for valuing historical asset prices. Let's explore two starkly different scenarios based on these measurement methodologies. First, if we use the current official CPI calculation to adjust silver's nominal peak of around $50 an ounce from 1980, we arrive at an inflation-adjusted all-time high of approximately $147 an ounce. Let that sink in. Even using the government's own conservative numbers, silver would need to more than triple from its current price of around $43 just to reach its previous peak in real purchasing power terms. This illustrates the massive upside potential from a historical perspective. However, the picture becomes even more dramatic if we consider the second scenario. If we apply the methodology that the government itself used to calculate inflation back in the 1980s, the figures are almost beyond belief. According to analysis based on that older, arguably more accurate, metric, inflation is not running at the current official rate of 3%, but closer to 12%. A chart produced based on this methodology calculated silver's inflation-adjusted high at a staggering $666 an ounce. Given the inflation that has occurred since, that figure is even higher today. Whether you lean towards the official figure of $147 or the more extreme figure of over $666, the conclusion is inescapable. Silver is profoundly undervalued relative to its own history. While gold is currently setting new records even on an inflation-adjusted basis, proving its metal as a store of value, silver has an immense, almost unprecedented, gap to close. This disparity is precisely what makes silver such a compelling investment thesis at this moment. It represents a potential value opportunity that is becoming increasingly difficult for serious investors to ignore. This disparity suggests that gold is leading the way, breaking new ground and drawing the world's attention to the precious metals sector. This is the historical pattern. But silver, the more volatile, higher beta metal, has the potential to follow with far more explosive force, playing a game of catch-up that could yield spectacular returns for investors. The historical lag in silver's performance relative to gold during the early stages of a bull market often sets the stage for a period of dramatic outperformance later on, a phenomenon many are now anticipating. This brings us to the core of the investment case for silver over gold right now. Beyond the inflation-adjusted charts, one of the most reliable historical metrics for valuing the two metals against each other is the gold-to-silver ratio. This ratio simply tells us how many ounces of silver it takes to purchase 1 ounce of gold. Today, that ratio is sitting at a historically elevated level of nearly 86-to-1, indicating that silver is exceptionally cheap relative to gold by historical standards. To put that in perspective, the historical average throughout the 20th century was closer to 50-to-1. Many analysts believe that given the current market dynamics, a reversion to a more normal mean in the 60s or 70s is not only possible but likely. When this ratio compresses, it means that silver is outperforming gold. If the ratio were to fall while gold simply held its current price, the implied price of silver would rise significantly, offering substantial upside leverage. Furthermore, silver possesses a dual identity that gold lacks, making its investment case even more robust. It is both a monetary metal, with a history of use as money that stretches back thousands of years, and an indispensable industrial metal. Its use in solar panels, electric vehicles, 5G technology, and countless electronic and medical applications provides a solid floor of industrial demand. This demand is not just stable. It is set to grow exponentially with the global transition to green energy and advanced technologies, adding a powerful secular growth driver to its monetary appeal. This industrial demand is largely inelastic, meaning that even if the price rises significantly, industries will still need to procure it to manufacture their products. This creates a strong support level for the price. We are at a remarkable crossroads where a confluence of forces, an accommodative Federal Reserve, persistent and potentially underestimated inflation, and growing validation from the mainstream financial world, has created a fertile ground for a historic bull market in precious metals. The stage appears set for a significant revaluation of both gold and silver in the coming years. Gold is leading the charge, acting as the steadfast herald of a new era of currency devaluation and economic uncertainty. But it is silver, the sleeping giant, that may offer the most dramatic potential for appreciation. It is a metal with a historical precedent for explosive moves, a current valuation that is a fraction of its inflation-adjusted peak, and a compelling narrative driven by both monetary uncertainty and burgeoning industrial demand. The combination of these factors creates a uniquely bullish setup that is rare in financial markets. The climb back toward its nominal all-time high of $50 an ounce seems more plausible than ever, but the historical data whispers of a potential far, far greater. The journey from here will undoubtedly be volatile, with sharp rallies and sudden corrections along the way. However, for those who understand the powerful fundamental forces at play, the long-term future for silver has never looked brighter. The current market environment suggests that patience and conviction could be handsomely rewarded as this undervalued asset begins to realize its true potential.